Accounting may be the hardest subject known to man. Debits, credits, cash flows. But don't worry, I'm here to guide you through this vast world of accountancy. Let's start first with a brief history, so I'm going to take you all the way back to the very beginning. Accounting as a concept can be traced back to ancient Mesopotamia to keep track of things like grain, bulls, and slaves, which holds all the way up to the Egyptians, the Romans, the Middle Ages, the Renaissance, all the way up to modern day. So you can see why accounting was very important. Wouldn't want any of your assets to run away. Nowadays, it's less about human capital and more about keeping track of various operational, financial, and investment information using currency values. Throughout all of this time, there weren't really any innovations. I mean, there's only so many ways you can write down the fact that you have more wheat this year. The only notable thing was the creation of what was known as double entry accounting by a Florentine merchant in the 13th century, but more on that later. Now, onto accounting itself. If I tell you to imagine accounting, what's the first thing you think of? Usually when people think of accounting, they'll usually think of, oh, debits on the left and credits on the right. And guess what? You would be right. But what do they actually do? You could ask, do debits increase or decrease the account? And I can ask you why your dad never came back. The answer is the same. I have no idea. It really depends on what kind of account you're talking about. Debits increase assets and expenses, while credits lower them. The opposite is true for liabilities, equity, and revenues. I just threw a lot of terms your way, and if you don't know what any of those mean, that's fine, we'll touch on those in a future video. Really, the only thing that is consistent is that debits are shown on the left side and credits are on the right side of a T account. This is a T account. It breaks down all of the transactions into debits and credits and allows you to sum them all up at the end and see your ending balance. What's important is that with every debit, there is an equal credit somewhere else and vice versa. This is what we call... Let's go through an example. Something simple for you amateurs. Cash. Cash, which is an asset, is increased by debits and decreased by credits. Let's say we live in a perfect world where all my videos don't get demonetized and I actually make some money. I will debit my cash account and the total goes up. But let's say I need to pay for something like an electric bill. Then cash would leave my bank account, so I would credit the cash T account. Add some more transactions here and there, and then you have your total of debits and credits. If you have more debits than credits, then you are what is called cash positive. On the other hand, if you have more credits than debits, then you are cash negative and rent's due, so you better sell a kidney. Now that we know what debits and credits do, how do we use them? As you enter debits and credits, the various accounts will move up and down and their balances will change. That's all well and good, but you need to make sure that you adhere to this one rule the whole time. The accounting equation, which is assets equals liabilities plus shareholders' equity, or sometimes just equity, where the assets part is everything the company owns. If it's available to use, then it's an asset. Cash, inventory to sell, vehicles, buildings, etc. The other side of the equation is basically who has a claim on those assets. Did they go into debt or enter into an obligation to obtain that asset? Then they have a liability. Did they receive investments or use profits to purchase the asset? Then there is a shareholder's equity. An example of this in practice is the scenario of me taking out a loan. I would receive cash, which means I would need to debit cash to increase it. On the flip side, a loan is a liability, and because liabilities are increased by credits, my loan account would increase by the same amount. Looking at it in the form of the accounting equation, we see that assets and liabilities both increase by $100. And since 100 equals 100, wow, very smart. I wish I was as smart as him. Did he really just say that? What a genius. Our equation balances and all is good, right? Well, just because your account's balanced doesn't mean that it's correct, but that's a lesson for another time. So, to recap, each financial transaction consists of a debit, left side, and a credit, right side, hence the term double entry accounting. And finally, all entries must adhere to the accounting equation of assets equals liabilities plus shareholders' equity. This type of accounting is important because it allows us to see who has a claim on the assets under the entity's name. This equation is the way to ensure that we did double entry accounting correctly. Thanks for watching. Remember to like, comment, and subscribe, and I'll see you in the next episode. Peace!